I'm a teaching professor in the Department of Finance here at Xavier. I'm the director of our Fifth Third Trading Center, and I guess I'm also the event planner for this event. So thank you all for coming. I welcome you all to Xavier's campus today. We have a fabulous event scheduled, but before we get started, I'd like to welcome Father Michael Graham, our president, to the stage for a few words. Father Graham.
Thank you very much, Kim. It's a pleasure to look out and see all these people here. This is, as Kim said, the second annual Matthew McCormick Cincinnati Investment Symposium, but it builds on a tradition that we've had here for a number of years before that, and it's great to see all of you kind of building on that. A number of years ago, a previous dean of the Williams College of Business, who will go nameless, remarked memorably and accurately that we, the faculty and staff of Xavier University, cannot possibly educate our students well for the world into which they are going. That we need all kinds of partnerships in order to do that job as well as we possibly can do it. And so you are here today, those of you who've come from someplace that isn't Xavier University, you are parts of those partners who are going to help us impact the lives of our students so that they go forth from here to do great things. You have a very rich day. I saw the agenda. There's going to be all kinds of people up here talking and opportunities for you to engage each other around the tables, no doubt. That's the what of it all, I suppose. I found myself thinking a little bit about the why of it. You know, why is it that you come together to do this? Student learning, yes, but at the service of exactly what? And as I thought about that, I thought back to leisurely days, now almost a month ago. Christmas is receding farther and farther into the rearview mirror, quicker and quicker. But I remembered a particular memory that seemed apt for today. A family tradition that has been around my family for a long, long time is watching one version or another of the old classic Charles Dickens story brought to the screen, A Christmas Carol. It depends on who's in charge that night. If Mom is winning the argument, then we watch the 1952 version with Alistair Sim. If Dad is winning the argument, then it's George C. Scott. If my sister has the remote, then we're watching Patrick Stewart. So, you know, it doesn't really matter who you watch, you always get a good story. And we know it all by heart by now. There's a part of it, one of my favorite parts, that happens in the beginning. You know how it starts, right? You know, Scrooge goes home, sits down by the fire with his bowl of whatever it is, you know, and soon he hears a clanking in the hallway, chains and stuff being dragged upstairs. And his old partner comes through the door as a ghost, bearing safes and file boxes and ledgers and so on, all of them hooked to this chain. "You are fettered," says Scrooge, trembling. "Tell me why." "I wear the chain I forged in life," replied the ghost. "I made it link by link and yard by yard. I girded it on of my own free will, and of my own free will I wore it." "But you were always a good man of business, Jacob," faltered Scrooge. "Business," cried the ghost. "Mankind was my business. The common welfare was my business. Charity, mercy, forbearance, and benevolence were all my business. The dealings of my trade were but a drop of water in the comprehensive ocean of my business." Marley has come to a realization too late that what he thought were ends were only means. And he confused those two all his life. At the end of his life, once it was over, he was able to see the two distinctly. And so that's what this is about, right? Means. Very important means. Means for doing what we must do and have been doing in point of fact. One of the wonderful bits of news over the course of the past couple of years, gone unnoticed by and large, is the number of people who have been lifted out of poverty steadily and year by year, and not because of failed experiments in various places around the world, but because of what you will be thinking about and learning more deeply today. So let's pause a moment, shall we? Grateful to God in prayer for calling us to important work, on behalf of his kingdom and his people. Holy God, we thank you for the chance to gather together around these tables, students and teachers and faculty, but learners one and all, and more than learners, servants. We ask your blessings upon us during the course of this day, that we always keep in mind the world into which we will be sent or have been sent, that we might be forces for good and change in that world. We make this prayer together in your own name. Amen. Thanks very much. Have a great day.
Okay, thank you, Father Graham. Sometimes I like to listen to sports talk on ESPN radio, and one of the hosts would always start the show with, "We are back and better than ever." And I thought that was a really appropriate opening for today's symposium. We are back and better than ever. Father Graham in person today. 255 attendees. Professor Siegel is our keynote speaker. Panelists from across the country. A student investment challenge, a new event at the symposium today. We have alumni in the house. We have 80 current Xavier students in attendance today. And of course, family and friends of Matt McCormick. This event, of course, could not be possible without our generous sponsors. So let me start by thanking Ball & Gainer, our partner sponsor. Our gold sponsor, McLaughlin Wealth Management, Morgan Stanley. Our presenting sponsor, Wisdom Tree, and all of our silver and bronze sponsors. And of course, the McCormick family. Thank you. I also need to thank my Fifth Third Trading Center staff. These students assisted me in planning this event today, and you'll see many of them on stage as moderators and presenters. They will be around all morning to answer any questions, so please do not hesitate to ask. Thank you also to Ann Ernst in our development office. Ann is here somewhere. Ann, thank you very much. Margie Simon and Vicki Bolden, our Williams College of Business and Cintas Center planning gurus. And thank you to the advisory committee for the McCormick Symposium. I created an advisory committee this past summer to help me plan this, to make this a bigger and better event. And I think it really worked out. So very quickly, if you could stand when I call your name. Scott Rhodes, Stephanie Thomas, Becky Wood, Bill Effler, George Haddad, and Susan McCormick, our advisory committee. Thank you. A few housekeeping items. We are offering CFP and CPA continuing education credits for the event. CFP forms can be found on the registration table. Please take one at break with you, and when you exit, they are blue in color. And if you're a CPA, please sign the CPA sign-in form, also on the registration table. We are giving away 10 copies of Professor Siegel's signed copies, of Professor Siegel's books today. If you are interested, we're going to be doing this over the course of the morning. Please put your business card or your name in the fishbowl, also located on the registration table. We'll be having 2 networking breaks during the morning. And of course, all this information can be found on our app that we're using for the event today. It's above my pay grade to try to explain how this app works, so I'm going to ask Matthew Tarka to come up to the stage to tell you more about it briefly.
Good morning, everyone, and welcome again. My name is Matthew Tarka. I'm the technical director for the show, and I just wanted to remind you that we have an app. So if you go to your app store on your device and download Guidebook, that is the app we're using in the platform. When you're in Guidebook, if you search for this symposium, the Matthew McCormick Cincinnati Investment Symposium, you'll be able to download it to your device. Once you're in there, to ask a question, you will go to the 3 bars in the upper left-hand corner. You'll then go in, you'll see 4 folders. There's the Keynote, the FANG Student Investment Challenge, Panel 1 and Panel 2. The Keynote, Panel 1, and Panel 2 all have questions within them, and it's just called the questions for that respective panel. And you can also connect with other attendees in this app, so I encourage you to definitely use this app. It's something we're trying new this year, and welcome again. Thank you.
Thanks, Matthew. Like I said, we are back and better than ever. So now it's my pleasure to introduce our next speakers, a good friend and a woman who needs no introduction, Susan McCormick, and our gold sponsor from Morgan Stanley, Kyle McLaughlin. Good morning, everyone. Good morning and welcome to the Matthew McCormick Cincinnati Investment Symposium. Thank you for being here today and choosing to attend this economic forum versus that other one over in Davos. I'd like to thank Dr. Staff Johnson for his friendship and respect for Matt in helping launch this event in honor of him. A huge thank you to Kim Renners and her team of Xavier Finance students for making all of this come together today. The planning required to execute an event of this size and magnitude requires persistence, due diligence, and many, many hours to get it just right. Thank you to every sponsor, especially Mullen Gaynor. Thank you to every investment firm and individual that Matt worked with. And thank you to Dr. Siegel for being here today to make this an incredible and impactful event. What a fantastic way to start off 2018. This continues to be such an honor, not only to Matt, which I know he'd be immensely humbled by, but it's such an honor for me and my kids, Patrick and Caroline, and Matt's parents, Diane and Richard, and to all of you who knew Matt personally. He would truly be humbled to know all of this is done in his name, and for it to generate such interest is incredible. He would be honored by all of you here today and all of the distinguished guests who've come to speak with us. Thank you for honoring Matt for his tireless efforts in both the local and national investment community, the emphasis he placed on routinely promoting dividend-paying stocks, his incredible relationship with the media, and sought-after market commentary proclaimed on CNBC, Bloomberg TV and radio, and Fox Business News. His consistently sought-after quotes published in the Cincinnati Enquirer, Cincinnati Business Courier, and the Wall Street Journal at a moment's notice. His passion and volunteerism to help a finance student find an internship and push them to be the best they could be. He elevated the profile of so many stocks, pounded the table on specific investment strategies, and brought to light specific banks and companies that met the investment strategies he passionately believed in. His impact within the investment community continues today, and your presence here is a testament to him and your commitment to the investment industry. To this day, I still receive phone calls, notes, and text messages telling me how much Matt impacted their lives and careers. As I reflect upon the past year and welcome 2018, the word that strikes me and is guiding me as I navigate the new year is impact. How can I make a solid impact on the lives of those around me, those who surround me, those who I interact with on a daily basis? How can I continue to share the impact of Matt McCormick's life on those he believed in so passionately? How can I impact the lives of those who I'm not around, yet I have a significant influence on? And I'm doing that in several ways. One, through this incredible event, and two, through the McCormick Brothers Endowed Memorial Fund. Both of these are impactful and touch lives in ways we can't see, but I know they help significantly. Matt was a big believer in giving back. He did that in numerous ways, both tangible and intangible. He did it by raising money for Xavier students in need, and he did it by mentoring Xavier students and helping them find internships. He pushed his interns to be the best they could be. I know he was tough and demanded a lot, and they often thanked him later for pushing them to be so. They often thanked him later for pushing them so hard, even though they weren't thrilled about it at the time. Matt often talked about, and I quote, boxing out, rebounding, and giving back to the community. He was the self-proclaimed official white guy. He stood 6'4", and he couldn't rebound at all, but he could foul like nobody's business. In all seriousness, he was passionate about giving back, and that is where he made an impact on young, promising future finance professionals who will one day also give back. To all of you current finance professionals who've reached a level of success where you can give back and make an impact, I'm asking you to consider mentoring a Xavier student and/or offering an internship if you're able. And lastly, I bring this to your attention as a potential recipient of your giving back generosity.
In front of you on each table is a card that describes the McCormick Brothers Endowed Memorial Fund and how you can make an impact on someone's life. To date, this fund has helped keep over 85 kids in school, specifically here at Xavier. And I am very, very close to reaching the $150,000 goal that Matt set forth several years ago. And I would love for you guys to help me reach that final 150. I'm very close, and the goal is to get it done by the end of this year. So please do consider that. Also, there is a business-sized card featuring Matt's very contagious laugh. And for those of you who knew Matt, you know exactly how this laugh sounds. So the quote that's on here guided him every day. Please take both of these with you, and please give serious consideration to giving back in Matt's honor. For all undergraduate finance students here today, and anyone else who's a Xavier graduate, there's an X pen for each of you. I believe they're out on the registration table. Please grab one before you leave if you don't have one, and wear it with pride. Matt usually wore 2 pins on his suit coat, an American flag pin and his X pin. It easily sparked conversations, and is really a simple thing to do. It speaks volumes about the things you are passionate about. Again, thank you for attending the Matthew McCormick Cincinnati Investment Symposium. It is truly an honor, and I look forward to its success for many years to come. Thank you very much. I will step aside briefly. Kyle, may have the floor.
Thanks. Thank you, Susan. It is truly a privilege to be here today to honor the life, the intellect, and the amazing spirit that was Matt McCormick. He was a great man, he was a faithful son, he was a loving husband, a loving father, he was a devoted brother, and he was a true friend. And I've known Matt and Susan since my freshman year at Xavier. I actually knew Susan first. She was my orientation leader. I think she may have some second thoughts about that after we got in a reasonable amount of trouble. And you know, Professor Siegel, you'll appreciate this. Matt and I met at the library where we spent the vast bulk of our time. It's actually not true at all. We met at a party, and like any 2 Irishmen, we bonded over multiple beers and outrageous stories. I can look out at the crowd at several of my fellow alums like George and Paul and Brad and Terry, and know that it wouldn't be possible, let alone prudent, to share many of our well planned out and incredibly mature adventures that we had together. And we all have epic McCormick stories, but what I really want to talk about is Matt McCormick was literally as good a friend as you could have. You know, the same guy who nearly got us into a fight with an entire sophomore dorm was the same guy who drove 6 hours to Pennsylvania to attend my dad's funeral mass, literally get back in the car and drive back to Dayton for a finals presentation on an endowment. Because that was Matt. He truly exemplified the Jesuit ethic of cura personalis, care of the person, care of others. And he was so much more than the stories, and the picture of him is perfect. It's the stories and the belly laughs. And it was Matt's intellectual brilliance. But Matt was, he was a man who was just dedicated to a lot more than that. He truly loved our business. He loved the investment business. He loved every part of it. And not just being on TV, not just CNBC and Bloomberg and that stuff. I mean, he loved finance. He loved stocks. He loved the stock market. And he was passionate about this business. And I think part of what made him so passionate was that he truly cared about the promises he made to our clients. And he cared about the trust that was placed in him by those clients. And Matt was just absolutely a man for others. And it was that care, and it was his boundless enthusiasm and his drive that made him such a success. And if there was something else that everyone that ever knew him knows, is that he loved this school. He loved what Xavier is, he loved what it represented, he loved how this university continues to grow and to thrive. And most of you probably do not know that he was the driving force behind the Xavier Distinguished Speaker Series. It would not exist without Matt. It was his force of personality that almost willed it into being. And there were a lot of people that said, oh, we can't ever get that done, you know, maybe in 3 years. And Matt was the one who said, no, we can get it done. We'll get it done this year. And so this symposium is absolutely the most appropriate tribute to my friend. Matt was a man of great intellect, faith, and humanity, and he was taken from us and his family far too soon. I'll close with a fitting quote from another great Irishman, Oscar Wilde, and it reminds me so much of Matt. Ordinary riches can be stolen. Real riches cannot. In your soul are infinitely precious things that cannot be taken from you. Thank you so much for your time.
Thank you, Kyle. Very touching. Thank you. At this time, I would like to introduce you to our keynote speaker. I am so pleased to introduce the distinguished and award-winning economist, professor, lecturer, columnist, and author, Dr. Jeremy Siegel. He is the Russell E. Palmer Professor of Finance at the Wharton School of the University of Pennsylvania. He holds degrees from Columbia University and MIT, where he earned his PhD in economics. He also spent 1 year at Harvard, where he was the National Science Foundation's postdoctoral fellow. Dr. Siegel also taught for 4 years at the Graduate School of Business at the University of Chicago. Professor Siegel has written and lectured extensively about the economy, financial markets, has appeared frequently on CNN, CNBC, NPR, and other networks. He's a regular columnist for Kiplinger's and Yahoo Finance, and has contributed articles to the Wall Street Journal, Barron's, the Financial Times, and other national and international news media. Professor Siegel served for 15 years as head of economics training at J.P. Morgan and is currently the academic director of the U.S. Securities Industry Institute. In his spare time, Professor Siegel has written these award-winning books, Stocks for the Long Run, and most recently, The Future for Investors, Why the Tried and the True Triumph Over the Bold and New. Professor Siegel has received many awards and citations for his research and excellence in teaching, including the Distinguished Leadership Award by the Securities Industry Association and the Nicholas Molodovsky Award by the Chartered Financial Analysts Institute in recognition of those individuals who have made outstanding contributions of such significance as to change the direction of the profession and to raise it to higher standards of accomplishment. He's also received the highest teaching rating in a worldwide ranking of business school professors conducted by Business Week magazine. Forbes named JeremySiegel.com as one of the best business school professor websites. Professor Siegel currently serves as Senior Investment Strategy Advisor of Wisdom Tree Investments, consulting the firm on its proprietary stock indexes. Please welcome Dr. Jeremy Siegel.
Thank you very much, Susan. It's an honor to be here. I'm especially thrilled there's so many students. So often I speak, it's just financial professionals, which I enjoy also, but teaching has always has a special part of my life. As Susan mentioned, I started my teaching career at the University of Chicago, 4 years, teaching at the Graduate School of Business, and I've been just finished my 42nd year teaching at the Wharton School. And I still teach the classes. It's still my biggest joy to be able to interact with the students and the young people. So when Xavier invited me here and they said there were going to be students in the crowd, I said, wow, yes, I definitely want to be here and share some of my ideas. There's so much going on. We're going to have a Q&A session afterwards. I want to go through some of my thoughts on the markets, valuation, and what kind of returns we can expect and how to think about it. And then, of course, I very much will invite your questions that come afterwards. So let's begin. These slides are for all the lawyers in the audience. Don't blame me if you lose money. You know, I always start my presentations with this slide. There's over 100 slides in graphs, and tables, and stocks for the long run. First edition was published 1994, where we finished a few years ago, the 5th edition. Total real returns over 215 years. It took me almost 3 years to collect the data. How does your wealth grow in the major classes of financial assets measured after inflation? All right, well, a single dollar put in a diversified portfolio of common stocks gives you now over 1.3 million. This is reinvested dividends, this is total real return, exactly as we financial professionals are mandated to talk about returns. Total, if you put a single dollar in long-term U.S. government bonds, you have about $1,600 after inflation today. The same amount in short-term treasury bills, well, you have about $265. This next one surprises people. If you put $1 in gold in 1802, now gold doesn't have any return outside its price, in contrast to stocks, which has dividends, and bonds, of course, which have interest. So it's a question of price after inflation. And that single dollar in gold in 1802, take it out today, sell it at the market after inflation, is worth $3.26. Not at all comparable to those financial assets. But by the way, a lot more than the US dollar itself, whose purchasing power has now fallen more than 95%. In other words, less than a nickel today of what a dollar could buy at the beginning of the 19th century. But I remember when that came off my computer back there in the late 1980s, early 1990s, and I looked at that and I said, one of the most striking facts about it was the stock line. What about it? Well, you can see this is done on a logarithmic scale. And that means that a straight line on a logarithmic scale is a constant real rate of return. And of all asset classes, there's the trend line. Least squares regression best fit trend line through those stock returns. We're going to look at those and what those returns are in just a moment. But I said, wow, in the short run, stocks are the most volatile of all asset classes. You notice all the ups and downs, the wiggles in that line are the great bull and bear markets over time. But in the long run, it had the most stable return. What are those returns? I'm giving those right on the left. The average compound after inflation return over 215 years in stocks is 6.8% per year, dividends plus capital gains. In government bonds, 3.5%. In treasury bills, 2.6%. In gold, 0.55%, just a little bit more than 0.5% per year. And the dollar's depreciated in purchasing power by about 1.5% per year. If you take a look, by the way, dollar and gold look almost the same. We were on the gold standard for 150 years, and then, of course, it deviated. We went off the gold standard. Almost all the depreciation in purchasing power of the dollar has come since the end of the Second World War. But what struck me was the consistency of the real rate of return on stocks. By the way, 6.8% per year doubles every 10 years. So it's a really fascinating story over the history of the United States. Your wealth in stocks has doubled after inflation on average every decade over the last 2 centuries. Wealth has doubled on average after inflation every decade over the last 2 centuries. Let me show you the consistency of this over here. We talked about the big return 1802 to 2017, 6.8. If you take the early period 1802 to 1870, 6.7, the middle period 1871 to 25, that's the Coles Foundation. I divided these into what was called the best availability of data. You professionals know about the Ibbotson series, the yearbook, 1926 to the present, 6.8. Since the end of the Second World War, When I mentioned all the inflation has occurred, also 6.9%. Look at how similar those returns are. Wow. You know that statement that your wealth on average doubles every decade? There's two important words in that sentence, and they are on average. We've had great decades, right after the Second World War, 10% a year. We've had terrible decades, 60s and 70s. We actually had negative real returns on stocks. And then we had the greatest bull market in world history. From 1982 through the end of 99 into the first few months of 2000. The average annual after inflation return at time, now think about this, nearly 2 decades, was 13.6% per year. That led us, as you'll see in a moment, to the most overvalued market in U.S. history, the end of 99, 88, 2000. And that's why over that period, even with the big rally that we had in 2016, we're up 3.9%. So it's below average from that peak that we had. After I wrote the book, there was a lot of interest. A lot of people thought, well, this is just, basically the United States, the world's most successful capitalist country. What happens if we go around the world and look at other stock returns? And 3 British researchers did that. They went to all the stock markets they could. Now, they couldn't go back 200 years, but, wow, they did a good job. They got 17, 18 countries back to 1900. They published their book in 2000 and did exactly what I did. What has been the average compound after inflation return? In stocks, in bonds, in treasury bills. Stocks, equities are the blue bars. Bonds, the red bars. Treasury bills on the green bars. And you know what's fascinating? The United States is not even number 1. Of course, actually, what is even more fascinating is what is, and this is, by the way, all measured in U.S. dollars, what is the best performing stock market over the last 115 years? Actually, South Africa. Then comes Australia. Then the United States. The world, the average rate of return, real rate of return, is about 5 to 5.5%. So it's about a point under that of the United States. But you can see from this chart, no matter what country you take, stocks, slaughter, bonds, and bills. And in those countries where stocks don't do as well, as you can see on the right-hand side of this chart, fixed income do even worse. The difference between the return on equities and fixed incomes is what we economists call the equity risk premium. It's been huge and enormous and consistent throughout the world and throughout different periods. There's been hundreds of articles written, some of you taken advanced finance courses, well, the equity risk premium, why is it so high? Why do people cling to bonds, even for long-term portfolios? Certainly, we know stocks are riskier in the short run, but in long-term portfolios, still huge amounts of bonds. It's interesting. I wrote a paper 20 years ago with Richard Thaler, who you may remember just won the Nobel Prize in Economics last December. It was announced in October. We wrote an article in the Journal of Economic Perspectives called The Equity Premium Puzzle. Why is it that? And it has a lot to do with that short-run volatility. People shy away from it, even when you show them data that in the long run, stocks are even more stable than bonds in terms of providing protection against purchasing power, inflation, and giving you a more consistent return. Okay. Let's talk about valuation in the market, because that's important. Here's the price-earnings ratio on the S&P 500, 1954 to 2017. So we're looking over 63 years, and yeah, we're above the average. This is a median of 17.02, as you can see there, and we're moving toward the high level. By the way, when we really had low levels, which was in the late 60s and 70s, is when we had double-digit interest rates. By the way, interest rates are also, as you're going to learn, very important and critical to what is the right PE ratio, what is the right valuation on the stock market. So that period of sub 10 is when you can get a 16% return on your 10-year bond. And that's quite a bit of competition for equities. As I mentioned to you, the highest PE ever, and you're going to see another longer chart, it's even higher than what we had in 1929. PE of 30 was the end of 99. Let me point out, because we're not there yet, as I said, we're about 22. We'll look very closely at PE ratios and how to interpret them for future returns. We're nowhere near that. And let me also remind you that we're in a world of much lower interest rates. Back then, when the PE was 30, actually treasuries were 7%. TIPS bonds were over 4. 10-year TIPS, inflation-protected securities over 4%. That's actually crazy. I'll talk a little bit about that. That's actually a negative equity premium, which then is the market is overvalued. And we'll look at that today. By the way, the market's not in a bubble at all at the present time. Even if it gets to 30, it's not really in a bubble. People say, well, when was a bubble? Well, here's the PE ratio of NASDAQ, which reached 600 in March of 2000. That was the dot-com bubble, but it infected. When we take a look back, it's actually interesting. Let me go back to that chart. The PE of 30 is actually a bifurcated market. The technology stocks in S&P, and those, by the way, were not the crazy internet stocks. They were all profitable. The only internet stock was AOL.